Hello, this is Ernest Burley, your CIA, your cool insurance agent, back at you again with some more great information on insurance. I'm a licensed insurance agent with over 30 years experience with clients all across the country. So I'm licensed in various states all across the country with clients in a lot of states all across the country. I specialize in various areas of insurance, whether it be auto insurance, home, life, long-term care, disability, commercial policies, business policies, church policies, what have you. I'm experienced in all those different areas of insurance. The purpose of this podcast is to give you objective and clear and unbiased information that will empower you, enlighten you, and educate you in the realm of insurance so you can make the right decisions for yourself and for your family. Make decisions that are beneficial for you based on having the correct information. So that's what this podcast is all about. So let's get at it. Let's talk about today's topic. Today's topic is titled LTC is TLC, long-term care insurance. So by LTC, I mean long-term care insurance, and TLC means tender loving care, right? So if you had enough thought process or foresight to say, hey, I want to think about this long-term care situation, then you're providing tender loving care to your family and to your assets. And we're going to talk about that. So long-term care, LTC, is tender loving care, TLC, because it is going to help out in the long run if something like that does happen. All right, so long-term care, by thinking ahead, you'll be providing tender loving care to your family because they won't have to scramble at the last minute and try and figure out what to do because they don't have the money, right? So it's best to have a policy in place because with more options, with more money, with more policies come more options, right? So let's do that. And you want to secure it when you're in your good health and at a younger age, because the older you get, the more it's going to cost and the more you may end up having some type of health condition. So I know a lot of people in their 30s or 40s or 50s, they don't think about it. Well, people in their 50s do think about it, but people in their 30s and 40s maybe not. But you know, if it fits in your budget, and we'll talk about some ways to try and, kind of make it fit your budget, make it more cost effective. It is better to get it at that younger age of 30, 40 years old, as opposed to older ages of 50, 60, 70 years old, because the rate is going to be much different and you may not even be eligible at that age based on what your health condition is. Okay. So let's jump into a few points. I'm going to go over like 7 main points. The first point is that this is a big gap I see in people's insurance portfolio. So when I'm doing insurance planning with clients, this is a big hole I see in a lot of people's portfolio because they don't think, people sometimes they think about life insurance. Of course, they think about health insurance and other areas of insurance, but long-term care, that's way off people's radar normally, but that is the thing that can really just crash your finances. So it's something that you really want to pay attention to. And it's something, unfortunately, and oddly enough, just about everyone, I would venture to say everyone has touched that type situation in some kind of way. Either someone in their family has needed some type of long-term care services, or someone they know, a friend or a colleague, someone that's connected to them some type of way, or connected to someone who's connected to them. They had to have some type of long-term care services. So people are very familiar with it for the most part, but a lot of people don't plan for it and don't have a policy to give themselves an advantage or a leg up if something like that were to occur to happen to them. So not having this protection can have severe financial and emotional consequences. The monetary cost, of course, is evident. It costs about anywhere from $80,000 to $100,000 a year for those type services. If you go into, like, say, a nursing home situation, for in-home healthcare, it's more like $55,000 to $60,000 a year. Assisted living facilities are more like $50,000 to $50,000 a year, and adult daycare is about $20,000 per year. So you can see, I mean, the cost is pretty substantial for that type of care. So it's better for you to have a policy in place in case something like that happens, so you can kind of mitigate that monetary cost. But then on top of that, you have mental anguish of caring for a person, the physical stress of caring for a person that you just alleviate your family from. Of course, the mental anguish is going to be there because your loved ones aren't going to want to see you in that condition or that type of situation. But if they're having to care for you also, that makes it even worse, because if they have to care for you in the house, as opposed to having someone come into the home or have you in a quality nursing facility or assisted living or whatever you determine your situation needs to be, it adds an extra layer of stress when people have to do that themselves and try to figure out, okay, I have to figure out a work schedule for working at home to deal with my loved one or take care of my loved one, in addition to like trying to work because I still have to bring money into the household. So it's a real tough situation. So it's better to have a policy in place while you're doing your insurance planning to alleviate that or mitigate that as much as possible. Point number two, it also helps maintain some control, right? You have some control over like your quality of care, what type of care you're going to get. Because if you have a policy, then you can kind of dictate what the quality of care will be, versus if you have no policy and you're just going off of what kind of money you have, that's a much different situation. And unless you're wealthy, then okay, it's not a big deal, but most people aren't wealthy, right? So you have control over the services that you'll be provided, and much more flexibility if you have a policy in place. And also you protect your assets. So you don't have to like sell all of your assets or sell a great percentage of your assets to try and have those services for yourself. So, you know, you protect your assets from being sold off, you preserve your estate for yourself, for your family, for your heirs, if you have a long-term care policy in place, because you don't have to sell off assets to have those services paid for. Okay, so let's jump into point number three. Just going to go over how the policy is triggered. So the main way the policy is triggered is if you can't do two of what they call 6 ADLs, activities of daily living, then the policy kicks in. So activities of daily living are things like eating, bathing, toileting, dressing, transferring, and incontinence issues. So if you can't manage two of those 6 activities of daily living, that triggers the policy for coverage. Also, if you have one mental like incapacity situation like dementia, Alzheimer's, that triggers the policy also. So those are the main triggers for a policy kicking in and paying a monthly benefit for long-term care services. Most policies do have a 90-day elimination period though. So you want to have some savings to cushion that 90 days where it won't kick in. And you can get the policy to pay for a certain period of time. So a 2-year, 3-year, there are different time frames out there that will give you a pool of money. So say for instance, if you have a daily benefit of $200 per day, that's the way the policies are normally arranged, as a daily benefit. So $200 per day is $6,000 per month, right? 200 times 30 days. So 6,000 per month is 72,000 per year. So if you have a 3-year benefit, 3 years times 72,000 is $216,000 of coverage. That's the pool of money you would have as a resource to pay for long-term care services. Point number 4, we talked about this or alluded to this earlier, to make it affordable or fit into a budget. So a lot of people, what they do is, I've done this for several clients, is they'll add a rider, a long-term care rider onto their life insurance policy, and that makes it much more affordable. So it lowers the cost of the long-term care protection, and it combines life insurance with long-term care protection in one policy. So that's a way a lot of people are really kind of making this thing much more affordable. So if something unfortunate happens and you can't maintain yourself, 2 of the 6 ADLs, right, or dementia, Alzheimer's, the policy kicks in, and say you have a $200,000 life insurance policy, it will reduce the life benefit dollar for dollar by what you use for long-term care services. So if you use $50,000 for long-term care services, that will reduce your death benefit to $150,000 for the life insurance part of your policy. But it's a good way to make it an affordable proposition for yourself. Point number 5, Medicaid versus Medicare. A lot of people think Medicare pays for long-term care services, and it does not. It may pay for up to 100 days of skilled nursing or rehab in a nursing home or something of that nature, up to 100 days. But after that, you're on your own. Medicare is done. Okay, so Medicare is not paying for long-term care services. Medicaid will pay for long-term care services, but you have to be impoverished. You have to be at the poverty level to have the state pay for it via Medicaid. So you don't want to be in that situation ideally. And some people, what they do is try to get slick and rename assets and things of that nature. But they have a 5-year look back period. So if you've been doing that over the past 5 years, then they're going to make you use what you did have access to before Medicaid is going to start paying for it. Okay, so let's just say, for example, you transferred $500,000 of assets out of your name over the past few years. So basically Medicaid is going to say, well, you got to spend $500,000 before we're going to kick in, because you really had those assets and you moved them out of your name to avoid having to pay for long-term care services. All right, point number 6, long-term care partnership. So this is a collaboration between private long-term care insurance companies and Medicaid, and it's designed to try and drive down the amount that Medicaid is paying out for long-term care services, basically. So if you have a long-term care policy that is partnership qualified, you'll receive an added benefit of a dollar for dollar asset disregard or spin down protection, whatever you want to call it. So whatever you had as a policy benefit for long-term care services, if you use that and exhausted that, that's how much money you can keep in assets. So let me give an example. Say, for instance, you had a $200,000 long-term care policy and you needed those services, so you exhausted those proceeds. You exhausted that policy of $200,000. Now with the Medicaid, instead of them making you spend down or have only $2,000 in assets, you can keep $200,000 in assets plus the $2,000 basic limit that they have at Medicaid. So you can keep $202,000 in assets instead of just $2,000. So that's a great way for you to protect your assets and make sure that you're not having to spend off your assets because you didn't properly prepare. Point number 7, last point. Long-term care premiums may be deductible, right? So you may be able to save some money here. So if it's based on your age. So you may be able to deduct a portion of your long-term care premiums if you have exceeded 7.5% of your AGI or adjusted gross income and qualified medical expenses. So, people over 60, I mean, you can deduct over $4,500 of your premium. That's a nice chunk to be able to deduct, but you had to have exceeded 7.5% of your adjusted gross income and qualified medical expenses in order to get that deduction. But that's a benefit. That's a great benefit in those long-term care policies. You can deduct the premium. Insurance doesn't the IRS doesn't normally let you deduct insurance premiums, right? Unless you're a business owner and you're deducting it. But personal insurance premiums, no, not so much. And that's it for today's podcast. Pretty short and to the point, right? So our recap. LTC is TLC for loved ones and for your assets. So long-term care insurance is tender loving care for your loved ones, for people who are going to care for you, who care for you and love you, to not put them in mental and monetary strife or anguish because of a long-term care situation occurring, right? And it also protects your assets because you don't have to sell off assets. You have a policy to pay for those services. So that's the recap. Just make sure that long-term care services, long-term care policy or long-term care insurance is included in your insurance planning, your insurance portfolio, okay? The takeaways. The activities of daily living, we talked about that. If you can't do 2 of what they call 6 ADLs, which are like bathing and eating, toileting, transferring, dressing, incontinence, things of that nature. If you can't do 2 of those 6, that triggers the policy. Or if you have one, mental incapacity like dementia or Alzheimer's, that triggers a policy for you. A way to reduce the cost of the long-term care protection is to get a life insurance policy with that rider. We talked about that. And we talked about the deductibility or the possible deductibility of the premiums for some people. So those are the key takeaways. Those are some big takeaways right there, okay? So thank y'all for listening. I appreciate it. I know some podcasts have been a little bit longer, but we're going to try and keep them shorter. I thank you for listening. Please spread this podcast to others and have them do so on and so on and so on, so we can make these podcasts viral and give everyone the information that will really help them out as far as insurance planning and insurance knowledge. To connect with me, if you have any questions on any of this information or any of the previous podcasts, my email address is ernestburleyjr@gmail.com. That's just my full name, ERNESTBURLEYJR@gmail.com. Or you can call my firm at 301-262-2600. Again, that's 301-262-2600. And my firm will be very, very delighted to help you in any way. All of my podcasts are available on YouTube. So you can always go to YouTube, go to my channel, Ernest Burley Jr., and all of my podcasts are on there. Plus some little snippets, like 1-minute snippets on different aspects of insurance and planning and things of that nature. Okay. So this is your CIA, your cool insurance agent, Ernest Burley Jr., signing off. Until we chat again, y'all take care and be safe out there. Okay.